I'm using the same title page that we used the last time, except maybe Xing out the question mark and just making it a statement, soft landing. And I hope that that's not a leading indicator of everything collapsing, but I think that we're at a point now, as Chris is introduced in his investor letter, that we can have a confidence that this very well may be the long anticipated soft landing. And we'll spend some time talking about that. But first, let's look at, so if you just look at a market dashboard, broad market indexes, it's been a mixed start, a relatively tepid start. Domestic indexes are up just over 1%, S&P 500 doing the best, up about 1.6%. But the broader market, 2000 Russell 2000 index is actually down about 4% year to date. The European market has done best of the biggest indexes, and China, actually, Shanghai Composite has really had a tough start to the year, and that's primarily a result or reflection of what's happening in China in terms of their real estate sector. Last year, there was a time when real estate contributed 25% of China's GDP, and it really has turned south on them in terms of the real estate market. In fact, the largest construction conglomerate in China, Evergrande, as you may know, is going through the process of liquidation, and it really will have ripple effects. We don't think it'll have an international effect, but it certainly will slow growth in China. If we look at the all-world country index, meaning all of the possible stocks that we can invest in, it's up about 50 basis points year to date. So here we go in terms of the markets in 2024. For those of us that are responsible for endowed funds and thinking about the market, not just a year to date or a month or last year or last 3 years, but really thinking about it in terms of generations and being stewards of assets that are meant to be in place in perpetuity, I think it's interesting and important every once in a while just to pull back the lens a little bit and just have a broader, more historical perspective. And I offer this as the S&P 500 price graph going back 30 years. And it just speaks to the long-term power of staying invested, weathering the ups and downs, and the promise, the hope, the opportunity for perpetual funds. As we look at this graph, this is a price graph of the S&P, as I said. There's a sharp uptick just at the end of the graph, and this represents the about 30%, 35% growth in the S&P since the market lows in October of 22. The S&P fell as low as just below 3,600, and today it's trading, much closer to 4,800. So it's been quite a rally that we've seen in the S&P 500. But what I think is, what I find really interesting is that most of the performance of the S&P 500 is the reflection or the result of 7 stocks. That really has driven the growth of the index. And in fact, if you take the top 7 performing stocks out of the index, it's represented in that lower line, what you might call the S&P 493. That basket of stocks is up just about 10% over this time period, over a year, whereas the top performing stocks, known as the Magnificent Seven, have returned over 70% over that same period of time. What results is the S&P index in the yellow line. And I think that it's important that we just recognize that it's 7 stocks that are really driving the market right now. There's a real concentration. And those 7 stocks have been coined the Magnificent Seven, kind of replaces what we had been talking about before in terms of FANG stocks. But the Magnificent Seven are made up of Apple, Alphabet, Amazon, Meta, it used to be Facebook, Microsoft, Tesla, and Nvidia. So it's worth. I think it's an observation. It's worth considering just the concentration in returns. The implication of that is that as we look at PE ratios across broad market indexes, what you find is that that Magnificent Seven, reflecting a 70% growth over the last 13 or 14 months, the PE ratio is significantly elevated from the index. The magnificent stocks on average are trading 48 times earnings. The S&P on a long-term basis, PE ratios have been about 18 or 19%. Currently, the S&P PE ratio is about 21 to 23 times earnings, but you can see comparable PE averages across different indexes, the Magnificent Seven, the Russell 2000, the S&P, the MSCI EFA, which is Europe, Asia, and the Far East, and then the MSCI EM, which is emerging markets. So it just gives you a perspective of where the return is concentrated and a recognition that those stocks, the Magnificent Seven, have really become very expensive, which could lead to volatility. You know, the higher the PE ratio, the more volatile the price of the security will be. In terms of interest rates, we can look at 10-year Treasury yields represented by this graph. It goes back to 2019. I'll just give you a sense of trends in the 10-year Treasury yields. It's a bellwether return. As you know, we saw a high of just over 5% in Treasury yields, and we've seen a sharp decline in yields since that time. This evening, Treasury yields closed at about 3.9%, so they've rallied 110 basis points. But as much as we want to talk about a soft landing and the probability of a soft landing and the like, the bond market still is just not there. The yield curve continues to be inverted. And as we've talked about in the past, the yield curve, we should see an upward sloping yield curve so that the longer term maturities have higher interest rates. You would expect that in a normal interest rate environment. But today, the yield curve is inverted. And the 2-year Treasury closed today at 4.2%. We've just said that the 10-year is at 3.9%. So it's an inverted yield curve by about 30 basis points, which still is a message from the bond market that, hey, they're not convinced that we're out of the woods completely yet. There's less skepticism. The yield curve was inverted as much as 100 basis points some time ago. There's been some relief, but there's still not a broad-based sense that we're absolutely out of the woods. So it's one of the most significant contra indicators to a soft landing. But nonetheless, that's where we are in terms of interest rates. There's broad expectation that interest rates will continue to fall from here. And in fact, based on the December meeting of the Federal Reserve, governors put their what's called dots in terms of their expected changes in interest rates going forward. So this is known as a dot plot. And what it does is it records the estimates by governors of where interest rates will be going forward, 24, 25, 26, and longer term. And what we see is that there's a consensus that the Fed rates will continue to decline over the next few years and come down to something longer term around a 2.5 or 3% rate. Right now we're at 5.5%, so there's a long way to go, and it's really the expectations of a 1 or 1.5% rate cut this year that's been a catalyst for the stock market rally. Certainly since October of 22, as we had talked about. In terms of the Fed currently, they met this week, announced that they were going to hold rates unchanged for now. So again, there's a consensus in the market that there will be a reduction of about 100 to 150 basis points in the Fed rate this year. But the Fed came out this week and said, we're not going to change it, at least for now, and probably not until June. Now, if that's the case, to try to get 150 basis points in the last 6 months of the year really is ambitious. And it probably wouldn't happen without a recession. So who knows what interest rates, how fast they decline, but the general consensus, even among the Fed, is that they'll continue to moderate going lower. So those are just a few observations around stocks and bonds and where we are today and how we're getting the year started. But let me go back to the investor letter that Chris wrote to each of us. And he had talked about, are we at a soft landing? And he had helped us to understand, to evaluate whether this economy is or is about to be in a soft landing. Really, you can look at three essential components of the economy. And that's inflation, GDP growth, and unemployment. And really, the definition of a soft landing is when the Fed implements a interest rate hike period or a cycle in an effort to reduce inflation back to something closer to a target. We know that it went up to 9%. They're trying to get it back to a long-term rate of 2 to 2.5%. So they've raised interest rates to reduce and to cool the economy, to reduce inflation. A soft landing is when the Fed is successful in doing that, but yet is able to continue to maintain GDP growth or economic growth and target levels of unemployment. And so let's check in, since Chris's investor letter, just on some of these metrics and what they're doing and where they are currently. Inflation was released earlier this month, middle of January rather, and it showed a continued moderation in a moderating trend in inflation. Both CPI and both headline and CPIX food and energy. And I think that what we should discern from this is at 3.4%, interest rates are significantly lower than they were. They're still 100 to 140 basis points higher than the Fed would like to see them. But the expectation is that inflation will continue to moderate. And so the trend is positive there. It shows that the Fed's program is taking effect, and it is, in fact, moderating inflation. So they're being successful at that. And the Fed and its program is being successful in reducing inflation while at the same time supporting a domestic economy that continues to grow and measured by gross domestic product. In the fourth quarter of 2023, we saw growth up 3.3%. And when you look at it historically, it's good growth in terms of, it's good growth. Absolutely. It's good growth in terms of relative historical. And when you read the headlines, this one caught my attention. Stunning and spectacular was one of the reports in the New York Times about how one economist described the latest GDP. So that's pretty good. And it certainly is the type of consensus that we'd be looking for a soft landing. But that just really struck me as the headline, stunning and spectacular. But what about unemployment, the third kind of variable that Chris had us focus on in his investment letter, which is unemployment. We've talked about the Fed having two primary mandates, that is maintaining asset prices and target unemployment rates. And what we've seen, or what we're seeing now, is unemployment right around 3 to 3.5%. And when you look at it on a historical basis, it's the lowest today that it has been since the late 1960s. So it's kind of the perfect storm here, a perfect positive storm in terms of these variables and supporting consensus, not a consensus, but a view of a soft landing. So Chris, we appreciated your letter this quarter especially. One of the quotes that just struck me from Chris's letter came from Envestnet PMC, which is the platform that the foundation uses for administration and back office, as well as a lot of the investment and research resources. This came from Brandon Thomas, a co-founder and the chief investment officer at Envestnet PMC. He wrote, "The consensus for 2024 among economists and analysts is one of cautious optimism, as the Fed is expected to begin lowering interest rates and inflation is anticipated to continue to trend lower." That really is the crux of what's happening in the markets today. Let me leave you with two other things that I think you'll find sources of optimism in terms of the market. The first is, let's look at equity returns following major pullbacks. And what you can see is a really consistent and I think interesting pattern. If we go back all the way to 1987, some major pullbacks in the market, Black Monday in 87, the outbreak of the Gulf War, the Asian crisis, the tech bubble, the Great Recession, the taper tantrum, COVID, and now the inflation spike. What we see is a very well-defined pattern of a major pullback in orange, followed by a recovery in that green color, and then a further acceleration of the recovery in the next period of time. And even this cycle that we're in follows that pattern, a pullback because of inflation. We saw that, we weathered it, we took bruises from it in 2022. We've seen then a recovery. And if this historical trend is to remain, then we would expect even an acceleration in S&P returns. So it's one data point, but it's something that we can use to have some optimism in terms of the equity markets. As we look at bond markets, as Chris had said in his investor letter, the expectation is that bonds are going to play a role in portfolios that they haven't for a number of years, and that they're going to be positive contributors, that they're going to moderate volatility and be a source of positive returns. And if you just look at the average US bond market total returns after Fed rate hike cycle ends, which we're at the threshold of right now, you can see the positive returns over periods of time following the end of interest rate cycle. So if this proves out again, it sets up really well for bonds to be a positive contributor into the portfolio. So I think that there's real source for optimism in terms of what we're seeing around the essential measures of a soft landing, inflation, GDP growth, unemployment, and some of the ways that the risk assets, stocks and bonds are kind of set up in terms of historical trends. Let's hope that they continue with those historical trends. So we use this graph or this visual last time. I don't normally repeat slides, but it just seems appropriate. It seems like we're well on our way, if not already at a soft landing, which is really exciting. I say that, and at the same time, just know that when we let our guards down, that's when things fall apart sometimes. So I'm not saying let's let our guard down. Let's continue to be disciplined and focused, primarily on the risk and time horizons of the money that you're managing. Chris does an excellent job of working with churches and understanding purposes of money and how best to allocate for different purposes of money, whether it be short-term or endowed funds. So let's not let our guard down, but I think that we can have a little bit of a celebration that things seem to be setting up for at least an avoidance of an immediate recession.